So before tax planning, you were paying $16,500 every tax season. And after tax planning, you are now paying $6,500 every tax season. Okay, that's a potential lifetime savings of $10,000. So what would you do with an extra $10,000? Today I'm going to talk about how tax planning can save you millions of dollars. But look, I get it, right? Because most people want to talk about the top line items of the income statement, total revenue or gross sales. And thus, they unintentionally focus less on the bottom line items like net income and after-tax profits. But listen, a wise man once said, it's not about how much money you make, but it's about how much money you keep. But many just take their last year forms and financials to their accountant, have them file their tax return, and then they end up paying whatever they are owed. But I want you to stop thinking about tax preparation or filing your taxes and start thinking about tax planning. And look, I'm going to be honest here, and I may end up exposing some tax professionals and even CPAs because many professionals simply are not setting up their clients to save money on taxes and have long-term success. So in this video, what I'm going to do is explain what tax preparation is, compare it to what tax planning is. We'll look at the ROI or return on investment of tax planning and what you need to know to save millions of dollars in taxes. Stay tuned. Hey there and welcome to our channel. I'm Sean with Life Accounting, the accounting company that helps you save on taxes and build more wealth. Before we dive into some very valuable information, please do us a huge favor by hitting the like button for the YouTube algorithm. It really helps YouTube decide whether or not to show this video to more people like you. All right, let's go ahead and get started and dive in with number one. What is tax preparation? So here's the deal, okay? The purpose of tax preparation is to look at an individual's or business activity during a taxable year. So that means looking at things like, okay, how much money you earned, your filing status, your current dependents, all your current assets, your qualified expenses or deductions, and a few other things in order to really give the IRS and other local tax authorities a strong financial picture on you, so they know how much you should have paid in taxes according to the US tax code. Now, the key word that I used here was review, okay? That means you or your accountant are looking at taxes retroactively. So basically, y'all are looking at what happened last year, and then you're plugging in the numbers and you're sending the tax return to the appropriate tax authority, which is usually the federal and state government. Now, that all sounds pretty easy, right? You're just plugging in some numbers. But I want to give the tax preparers some credit here because they still make sure their clients are compliant and they're filing their taxes as accurately as possible, at least the ethical and good ones, right? Which is very important because a lot of people end up screwing up their taxes. Okay, let's move into my second point, which is number two, the problem with tax preparation. So it may be obvious by now, but the major problem with tax preparation is that it is not proactive. The goal of tax preparation is not to reduce tax liability. But again, the purpose of tax preparation is to file a tax return correctly and to try to take advantage of as many deductions or tax credits available based on what happened last year. Now, okay, sure, some tax professionals, including myself at times, will say, hey, I found this tax deduction that you didn't know about, so I help you save on taxes because of that. But again, okay, this is just us looking at things retroactively. And the truth is the taxpayer was already entitled to that deduction. They just didn't know about it. Plus, that doesn't happen for every tax client. So the problem here is that tax preparation does not take into full consideration all the taxes that will happen in the future. And while there are a few strategies that you can implement during the tax preparation, the vast majority of opportunities for reducing taxes occur during tax planning. Which brings me to number three. what is tax planning? Now, the purpose of tax planning is to be proactive. Essentially, you or your tax accountant will be doing a full analysis of your business and or your life to get into a state where you are paying less in taxes. Now, tax planning doesn't mean you need to go out and find every single tax strategy that is available to you and to use it. The truth is, the US tax code is over 70,000 pages long and it's pretty overwhelming. And sometimes people, including tax professionals, become paralyzed with the fear that they are incapable of fully digesting all that information. Okay, I can't digest any more tax information. Okay, but look, you don't need to know every tax strategy. In fact, you can save hundreds of thousands of dollars over a lifetime with just 3 to 4 really good tax strategies. Which, by the way, if you haven't subscribed already, make sure you do, because we talk about different tax strategies on this channel that you can implement all the time. But if you need immediate help, then make sure you consider working with our team on a custom one-on-one tax strategy where we do a complete analysis of your financial life and help you come up with a tailored tax plan. Just click the link below where it says tax planning and apply. All right, let's move on to number 4 and talk about business owners versus individuals when it comes to tax planning. We talk about on this channel all the time how business owners, like self-employed people or independent contractors or LLC owners, and in addition to that, investors, are afforded the best tax write-offs. And from a tax planning perspective, owning a business opens up significantly more opportunities than individuals who are just earning W-2 income. However, that being said, there are still some things individuals can implement. For example, one of the more basic and important strategies for individuals is to do retirement planning. Okay, that can have a huge impact simply by maximizing your annual contributions to a retirement account that can compound and turn into hundreds of thousands of dollars in tax savings. High net worth individuals also have more opportunities for tax planning because they usually have other assets or investments, so they incur what is called an alternative minimum investment income tax. Well, with strategic tax planning, you can also minimize that tax. Also, high net worth individuals have stocks and securities and can take advantage of tax loss harvesting as well as the 83B elections. Now, when it comes to business owners, like I said, they have significantly more opportunities for tax planning because they can look at things like, okay, the home office deduction, or deducting travel expenses, or maximizing depreciation, writing off meals that are both 50% and 100% deductible, using things like the work opportunity credit, looking at different healthcare strategies, or even more advanced niche strategies like the R&D credits. And that's just scratching the surface. And of course, business owners can still take advantage of the individual tax strategies that I mentioned as well. So the bottom line here is that business owners especially need to be paying attention to tax planning more than anyone else because they have so many opportunities for tax savings available legally within the tax code. All right, moving along to number 5, tax planning versus tax preparation. Now, as an entrepreneur, I am constantly looking at the cost and the ROI of doing different things, and it's no different when it comes to tax planning. So for me, if I wanted to invest in tax planning, then it would need to be worth my time. Now, luckily with tax planning, there is actually an ROI, which, by the way, ROI stands for return on investment, because tax planning is one of those things where you can spend money and actually make money. Let me explain it to you with 2 different scenarios. Okay, scenario 1 is where most people fall into, and it is a tax preparation scenario. Okay, let's say, for example, you earn $100,000 in net income or profit, and as a result, you owe about $15,000 in taxes. Well, with tax preparation, your cost would look something like this. this. Okay, you have your tax payment of $15,000, plus you have a $1,500 tax preparation fee in order to file a business tax return. So your total cost under this scenario would be $16,500. And if you don't end up coming up with a plan, you'd have that same cost again next year. Okay, so that's scenario 1. Now let's look at scenario 2 with tax planning. So with tax planning, let's say that you identify proactively that next tax season you're gonna owe $15,000. And because you know that, you start proactively trying to implement tax strategies to reduce your tax burden. But you're busy, you're a business owner, so you decide to hire a tax professional to help you for $3,500. And the tax professional is able to help you save $10,000 in taxes through various different tax strategies. Well, with tax planning, your costs will look something like this, okay? You'd have a tax payment of $5,000 instead of the $15,000 from the last scenario, plus a new $3,500 tax planning fee, plus your usual $1,500 tax preparation fee. Okay, simply by tax planning, you were able to bring your total cost down from $16,500 to $10,000. But that's not all, because now every year going forward, you will be able to save at least $10,000 without paying for another tax plan. So next tax season, your total cost will be even lower, going from $10,000 to $6,500. So before tax planning, you were paying $16,500 every tax season. And after tax planning, you are now paying $6,500 every tax season. Okay, that's a potential lifetime savings of $10,000. So what would you do with an extra $10,000? Tell me in the comment section below. Okay, but here's an option for you. Okay, what if you invested the $10,000 and got a 7% return over the next 30 years? That would turn into $1 million. So the true ROI of tax planning is crazy. I mean, based on that, it would be like $1 million are up for grabs. Now, if I'm blowing your mind, then you may be asking yourself, why hasn't my accountant or CPA ever talked to me about building a strategic tax plan? Well, here's the deal, okay? In my opinion, tax preparation is easier than tax planning. That is not to say that tax preparation is easy, but it is easier than tax planning, okay? Remember, the tax code is over 70,000 pages long, and there is a lot to review, there's a lot of analysis, and there's a lot of critical thinking that comes with tax planning, whereas tax preparation is mainly just putting in numbers. So the average established accountant or CPA may not have the time to sit down and carefully think through your tax plan. It's much easier and scalable for that CPA or accountant to just do the tax preparation. And in the worst cases, some accountants and even CPAs just don't know how to effectively do tax planning. In fact, the main way that I was able to acquire most of my knowledge around tax planning is because I own 2 businesses and I needed to implement these tax strategies for myself. So if you need help, remember we are offering custom one-on-one tax plans at our firm. So click the link below if you would like us to do the work for you. All right, moving on to my next point, number 6, implementation. Now you need to know there's an important gap between tax preparation and tax planning that we need to talk about, which is implementation. Now you've probably heard these popular quotes before, like a plan without action is not a plan, it's just a figure of speech, or a plan without action is nothing. Well, that is absolutely true when it comes to tax planning. Okay, most people have no idea how to tax plan, but once you actually have a tax plan, then you've already conquered half the battle. The next step is to implement it. Okay, so what does that mean? Okay, let's say for example, you have a tax strategy like the Augusta rule. The Augusta rule allows you to rent out your home or your apartment to your business for work purposes. So great, the plan may be for you to use the Augusta rule to get a bigger tax deduction at the end of the year, but you actually have to do it, right? Like you have to set up a business event with your team and your clients to take place at your residence. Hey Sean, look, I rent out my home for business 14 days a year. So action and implementation are key. Okay, so I threw a lot at you today. Let's go ahead and put a bow on all of this. So tax preparation is the process of reviewing your financials, then submitting it to the IRS and other tax authorities, which is retroactive. Whereas tax planning is the process of reviewing your activities and finding different strategies to reduce your tax liability, which is proactive. Now, both individuals and business owners are great candidates for tax planning, but business owners have the biggest opportunity. And because of that, the ROI of tax planning is astronomical, as you saw, where you can make over $1 million with a simple tax plan. But overall, tax planning is worthless if you do not implement anything. And that's it, okay? So I hope you really enjoyed the video. I think it's one of my more valuable videos that I've made to date. So please don't forget to like, comment, and subscribe. We have 2 more videos coming up next that you may enjoy as well. So if you haven't checked those out already, make sure you do. And I'll see you over there.